Let's get to our next segment. It's the wrap the week. So as always, we like to take a step back, look at things how are evolving, but we also like to ask you a lot of questions about what you're seeing, what you're thinking. And one of the questions we asked on our poll on StockCharts TV: which sector do you think will perform best over the next 3 months? And I gave you four choices: consumer discretionary, consumer staples, materials, technology. The vote overwhelmingly, over half, a clear majority for technology, 58% of our responses. 22% of you said materials. And then between consumer discretionary and consumer staples, only 19%. Interesting, a couple observations. Number one, over half of you voting with the continued strength in technology. I did not respond in this poll, but if you asked me to vote, I would probably say technology as well. And the reason is because it is demonstrated over the long term. If you look at the long-term chart of the XLK, it has been good offense, it has been good defense. And I mean, when the market's done well, technology has tended to outperform. When the market's done poorly, technology has tended to outperform. And something that is good offense and good defense, good in both sides, in both regimes in general, that's the kind of thing you'd want to certainly be looking for potential for further upside. And so I think you're in good places. The people, those of you that voted for materials, that's not a bad call. And if you remember our mid-year panel, part of Charting the Second Half, I hosted that panel with John Kosar, with boy, I'm blanking on who was on that show. It was such a great discussion. We had Julius DeKempener on there. Greg Schnell joined us. And we had this great discussion about where we saw things headed. And I think most of them picked materials as the number one sector. 2 or 3 out of 4 picked materials. And it's the gold trade. It's thinking to, and it's not just gold that's leading in materials. It's a pretty decent sector across the board with other parts of it as well, chemicals and other parts of the material space. Consumer not getting a lot of love on the poll here, and I understand why. With some notable exceptions in consumer discretionary, on average, you've seen better performance from some of these other sectors. That interplay of consumer discretionary versus staples is an interesting one. I'll keep watching going forward for sure. Let's move on, continue our discussion here as we wrap the week. So just very quickly on today, before we get to the weekly look back, as I mentioned, the S&P essentially flat on today, on Friday. So yesterday was the big move higher, and it certainly felt like 3,400 was attainable today, not to be. And today we essentially were flat, with the S&P just finishing right above 3,350. The big move was in mid caps and small caps, with small caps up almost 2% today, with the small cap index, the S&P 600, above 911 now. So certainly some upside there on the more speculative side, the higher beta, lower market cap stuff. The VIX now down below 23. Just very quickly with other asset classes, bonds weaker today in a fairly significant way, 2/3%. And the gold and silver trade, which has been absolutely gangbusters to the upside, took a breather today, with gold down 1.5%, silver down 2.5%. So we've talked about this situation, I think, where there was a positive correlation between stocks, bonds, gold, everything kind of going up, the dollar going lower. That sort of flipped around today. You had a stronger dollar, weaker bonds, weaker precious metals, flat stocks. So, but strength if you look at something like small cap. So a bit of a reconfiguration of that overall trend. We'll have to see going into next week, obviously, what the long term picture tells us. I just wanted to look very quickly as we start our weekly review here, thinking about the trajectory of different asset classes and then some different themes and styles within the equity space, starting at the June market high. So if we start the clock at that June high, that's back here, June 8th. If we look from there, you'll see how things have evolved. The S&P let me just refresh the chart here because we've traded a little bit. There we go. So the S&P up 4% from its June high. That was that initial peak in June. We pulled back and then now have broken above it. So the S&P now sitting 4% above there. You can see small caps have lagged behind. They've come on strong, and that's, when we think about today, we think about that uptrend. Look at just the slope of the lines here, with small caps really accelerating, where the S&P is more of a steady gainer, looking close to close. So small caps have emerged, but overall still down less than the S&P from the June high. The only asset class that out of the major ones we're tracking here down since that June equity peak is the dollar, which is 3.5% or so weaker. What's interesting, though, is look at everything that's up a lot more than the S&P just since that June high. Crude oil has outperformed by about 1.25%. Bonds are up 8.5% plus. since the June market high. The NASDAQ up 12.5%, Bitcoin up 18%. The big winner, though, out of all those asset classes, gold up 19.5%. That's even giving a couple percent back today. So overall, it's worth noting, even though the S&P certainly has strengthened, certainly, testing that key 3,400 level with a lot of people speculating much further upside, it's worth noting that only two of the sort of key themes we follow have gone up or gone down or gone up less than the S&P during that period. Everything else has actually outperformed the S&P. Now, when you go a little deeper in the equity space, let me refresh this chart as well. When we look at that same time frame, we start the clock on June 8th and go to where we're at now. Here again is the S&P up 3.9%. It's basically 4% there. What have our other markets done? Emerging markets have outperformed. They're up 7.2%. The NASDAQ again up 12.5+%. Small caps up a little less, as we mentioned. Let's look at the other non-U.S. markets, though. Frontier markets and developed markets essentially flat for that period. Also mid caps. Now those sold off obviously a lot in the first week, and then sort of retested those lows there in late June. But since then, they've basically just gotten back to flat. So while the S&P is broken out, these actually have not broken above that peak from early June. So it'll be interesting to see, as you think about further upside in stocks, do you see these sorts of markets, developed markets, that's EFA, mid-cap stocks, are they able to sort of break out of that range and especially get to the point where they may be outperforming the large cap equity universe? Has not happened yet. We're going to pivot now and go to the Mindful Investor Live chart list. We do this every Friday, and if you're not familiar with this, I'm sorry, that's Google's webpage. If you're not familiar with this, what we basically do is if you to access this, you go to the articles page, click on my blog, which is called The Mindful Investor. You'll see a link at the very top to access my live chart list. It's this list. I'll keep it updated, and you can refresh it with latest charts. You're welcome to take them and do whatever you want with them. Let's start at the top and go quickly as we can through as many of these through the remainder of our weekly wrap here. First off, it's the S&P market trend. It's the long-term weekly chart using the 21 and 34-week exponential moving averages. Those turned bullish in June and remain very much in a positive uptrend, suggesting we're long and strong up into the right. For me, the medium-term trend is defined by the weekly PPO, which is essentially the weekly MACD. Same idea, very similar calculation. That turned positive in May, in early May, and has remained positive since then. So that was, one of the signals coming out of the March low. We had that pullback in April. We then broke to the new highs in swing highs, going into April into May, and that's when this sort of triggered on the bullish side. For me, I basically look at the spread between those two moving averages and consider that just a brief short-term signal, just using weekly data. It's not how I would trade on the short term by any means. It's a good placeholder for what the short term trend is. That's switched positive because the moving averages are now once again spreading out. So it's basically at this point, long term, medium term, short term, all bullish at this point. The next chart is the daily S&P chart, and things to point out here. We have this bearish divergence of higher highs in price June and July. We then had the lower peaks in RSI here, June and July. Since then, we've broken above there, and I've talked about how that sort of ruins that bearish divergence. What's interesting, though, is you could potentially make sort of another one with this peak, and then this peak, and this peak. So taking the higher highs in price, if we would top out around here, and the lower peaks in the RSI, that could end up looking a little more like a divergence. The weekly chart is going to make that look a little more clear. I think on the daily chart, I wouldn't call this a divergence anymore because of how the fact that was a clear peak that kind of got invalidated. But we're going to talk about divergences in a little bit. One of the questions from the mailbag deals with that. So I'll get back to that concept in just a little bit. This is our look at breadth. So now that we've understood price in an uptrend, let's look underneath the hood and look at some of the breadth themes, breadth characteristics we can review. Here's a daily chart of the S&P. This is the breadth in the form of the cumulative advanced decline line. This keeps making new swing highs, and it's definitely bullish for the S&P 500. Looking at the other groups I pay attention to, this is the New York Stock Exchange, a broader look of equities. This I consider still neutral because it hasn't gone above the peak from June. This is the mid-cap index, actually just testing to go to a new high from January and February. We tested that in June. It's so close. I don't know if I'm going to call that a clearing of that or not, but pretty close, going from neutral to bullish. The small cap one's still not above its June high, and that's what I would consider it's still neutral. So you sort of have partial bullish, partial neutral, which is about right. That's about what the overall equity feeling has been. In terms of stocks making new highs, you've had a steady stream of a handful of stocks. It's been at most, it's been about 5 to 10% of the S&P making a new 52-week high on any given day, which is fine. That's not bad. I mean, when that evaporates, that tells you that we're in a corrective pattern. We haven't seen that. What's interesting is, though, when the market really gets extended, you usually get many more stocks making new 52-week highs. And I think the problem is most stocks are sort of still in this wilderness between their January, February high and the March low. They haven't been able to eclipse it yet. But we're getting pretty close. And again, this might be just a similar group of names kind of going higher for the big tech trade. If this, I'd want to see this number break out to the upside, suggesting more and more stocks actually doing what the S&P has not done, which is breaking above its early 2020 high. That would give me a lot of confidence about a move further beyond S&P 3400. In terms of stocks above their 200-day, stocks above their 50-day, I had a couple guests this week that did a great job of breaking this down. So if you missed that, go to Tuesdays and Wednesdays show, if I remember right. Gary Dean certainly did it. Andrew Thrasher, I want to say, referred to this indicator. And for me, they were talking about the divergence, higher highs in price, a divergence, lower peaks in this breadth indicator, which is totally valid. I tend to pay a little more attention to stocks above their 200-day. And as long as this remains above 50% on any pullback, I'm going to feel pretty good about the overall sustainability. And at this point, it's at 56% through yesterday's close. Sentiment, we talked about yesterday, the AAII rankings, and also Gary Dean, if I remember right, we talked about that. I might have been making that up, but we did talk about that in pretty good detail yesterday. And overall, not a lot of bulls for where we're at in this phase in the cycle. Testing threatening new highs. It's still 2-to-1 bears versus bulls, which is sort of unusual if this is a market top at any point. So it doesn't feel toppy there. Here we're going to start to get into a little bit of ratios to finish up our weekly look at these at the chart list. Overall, it's been kind of flat looking at consumer discretionary versus consumer staples. Interesting in our poll this week that it was about a 50-50 split between those two. It was 10% in one and 9% in the other, picking that as one of the best sectors. That's actually interesting. It'll be very interesting to see if this ratio can break one way or another. At some point it will. Another interesting one is looking at the ratio of consumer discretionary versus technology, which has really been sideways since the March low. The two of them have actually been relatively similar to one another, which is kind of surprising to me. I think not seeing this, I would assume technology to have dramatically outperformed consumer discretionary, but it's not been the case. It's essentially been sideways for the last 5, almost 6 months now, which is kind of interesting. A couple of these are just key themes to remember. Semiconductors over the long term, they pulled back today, but overall the relative performance has been strong. That is a bullish signal for stocks. The small cap universe has been outperforming the large cap universe for the last 4 weeks. That's bullish overall on average if we look back through market history. Growth continues to outperform value. I don't see that changing at the moment. So that's continuing to be pretty consistent. Then the last one I'll leave you with is this chart. We looked at this earlier in the week, if I remember right, and I think the ratio of high beta to low volatility has essentially been flat. It came off since the June market peak, and since then it's been sideways. If this could break out to the upside, that would certainly put more fuel in the S&P higher than 3,400 camp. If this sort of remains stagnant, it tells you that there's not a lot of juice, that this would need to go higher, I think, to propel the S&P materially above S&P 3,400. So that's a chart I might look at to confirm as we near those highs.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.